You're listening to Explain That by Velocity Legal, the podcast that keeps business owners and professional advisors ahead of the curve in an ever-changing legal landscape.
Today we're talking about Division 7A. Now, many business owners, they treat their private companies as their own things. And many unknowingly create tax risks when they do things with those companies, whether borrow money, use company assets, or forgive those loans. And they do those things without realizing that those actions can have serious tax consequences under Division 7A. So today what we're going to do is we're going to break down the common pitfalls, how they arise, and what advisors need to do and need to know to keep their clients compliant. Today I'm joined by Archana Manapakkam, Special Counsel in Tax Law and Structuring. Archana, you've spent years advising business owners on all sorts of things about structuring, complying with Division 7A, getting out of tax problems, avoiding tax problems in the first place. And I know a lot of that work you've done is around Division 7A. So firstly, welcome to the podcast.
Oh, thanks for having me, Andrew.
Well, first off, let's get into Division 7A. Now, before we get into the specifics of it, assume I know absolutely nothing about Division 7A. How would you describe it in a nutshell?
So Division 7A, it can apply where there's a company, a private company. And it's essentially what they call an integrity measure. So it's when it can apply where you're basically ripping value out of a company to a shareholder or an associate of a shareholder, for example, their spouse or another company or another entity that they control. And you're ripping it out in a way that it's other than as a dividend. Yeah. So when it applies, it can deem certain, if you're, for example, ripping it out as a loan or a payment or by way of forgiving a loan, it can apply to deem that transaction as a dividend in the hands of the shareholder. And it's generally not franked.
Yeah. So in other words, there's integrity provisions which say that if you do these things and you do them in the wrong ways, we're going to treat those things as deemed dividends, these sort of fictional dividends. And, you could be looking at what? The top rate of tax on
47%.
On those amounts.
If you don't, 45% plus 2% Medicare levy. If you don't know what you're doing, if you, say, loan out $100,000, you could be up for tax of $47,000 on that.
Well, that's huge. And then, the company would have paid tax on that $100,000 in the first place as well. So, your effective tax rate could be sort of 60, 70%, if you trace through from, how the money came into the company in the first place.
Yeah, absolutely. It can be huge.
Yeah. Archana, a lot of business owners will treat a private company as their own, and they will take money out of the company, willy-nilly, without considerations of tax. What are sort of some of the biggest misconceptions that you see when advising business owners on Division 7A?
Obviously, it's a separate entity. It's not the, whatever the company has, whatever its assets, its money, it's not the assets of the shareholder. So when you're taking value out, it's a separate transaction. And that needs to be accounted for as such. And you need to look at what the implications are, for example, under Division 7A, if you're not taking something out as a dividend. So I think when people are taking out loans, for example, if they control that entity, they might not even document it properly. It's quite common in sort of related party transactions that there won't even be a loan agreement. It might appear as a loan in the accounts. Sometimes it doesn't even appear as a loan in the accounts. Sometimes it's just money moved from one bank account into another bank account, but I intend to put it back.
Yeah,
That's not enough.
It might be that the business owners spent, 400 transactions that are private use throughout the year, and then the accountant's looking down and saying, okay, well, we need to book these as a loan.
And it needs to be, there are certain requirements in terms of, terms of the loan in order to avoid, and we'll come back to this later, in order to avoid there being a deemed dividend under Division 7A.
Yeah.
That's one common misconception. Another might be, oh, well, this company has some assets. Maybe it's got a car. We don't really use it for business purposes on the weekend. I'll just use it for my private purposes on the weekends. That can also have Division 7A implications.
So that's that use of company assets type situation where the company's got something that's not 100% business use, and Division 7A can also attack that type of situation where that asset's being used for private use. Yeah.
So I think we'll come back to this a little bit later, but the types of transactions where Division 7K and 7A can apply is where there's a payment from the company to the shareholder or an associate of the shareholder, including former shareholders and associates of those former shareholders. So there's a payment. A payment includes a use of a company asset. It can be a loan from the company to that other entity. It can be forgiveness of a debt. It can also be things like, we won't go into this, it's very complicated, things like guarantees as well, where the company provides a guarantee in favor of the shareholder or the associate.
So what's the most common you see? Is it, typically I see it would be loans, but would you say loans is probably overwhelmingly the most common situation where you're dealing with Division 7A?
I think so. I think when payments don't come up that often, I think most people would just think that that's a dividend, so they try to come up with, they don't ordinarily just make just a voluntary payment and not characterize it as anything. So normally loans.
So let's say we've got a company, it makes a loan. One option is obviously you just don't make a loan in the first place or pay it back. But let's say I'm a business owner and there's a loan made. What options are on the table in terms of those loan agreements?
So if that loan is repaid by the lodgement day of the company's tax return for the income year in which that loan is made, you can avoid, there won't be a deemed dividend arising.
That'll sort of be around May the next year.
That's right. So so for example, if in the last financial year, so that's the 2024 financial year, you made a loan, the company made a loan. If that's not repaid, if that's repaid by lodgement date for the 2024 tax return for the company, so around May this year, if that's repaid, then there's no deemed dividend.
Yep.
Alternatively, you can place that loan on the terms of what's called a Division 7A compliant loan agreement by the lodgement day. So that needs to be, there's certain requirements that need to be satisfied. So it needs to be, there's a maximum term. So the maximum term is 7 years, or it can be 25 years if it's secured, if that loan is secured by a mortgage over real property and that fully secured, and that property has a market value of at least 110% of the value of the loan. The loan agreement, so that's the maximum term. There also needs to be interest at what's called a benchmark rate, which I won't go into, but they vary from year to year. That varies from year to year. And the third requirement is that it needs to be in writing. So if you get a loan agreement in place that meets all of those requirements by the lodgement day of the tax return for the year in which the loan was made, then you can avoid a deemed dividend from arising.
Yeah, and you have to do those things. So you've got to do one of those things, right?
One or the other, otherwise you've got a deemed dividend.
Yeah.
And that arises in the year in which it was made.
Yeah.
And the loan was made.
And going to those loan agreements, and you said, a lot of the time these transactions will be done or won't be documented. I'm assuming that's those loan documentations are done kind of well after the end of the financial year. It's got to be done within that time period, but it's not really done at the same time as those transactions are happening.
Yeah, that's right. So you don't have to do it contemporaneously, but it needs to be, you got that lodgement day deadline to get that in place.
With those interest rates you mentioned now, I've got some experience with this as well, but that interest rate you have to pay, that's changed over time, and it's sort of, it fluctuates with RBA rates basically. And I remember during the COVID period when the rates were almost next to nothing, it wasn't too bad. It was probably like 5 or 6%. But now that rates have gone up, that interest rate's a bit of a killer, isn't it? It's about 10% now, isn't it?
Yeah, it is very high now. So yes, that
Yeah.
is a big cost of entering into these type of arrangements.
Yeah. So then you probably look at things about, okay, is that interest deductible? And if the money's being used for personal use, you're not going to, it's just a cost
That's
that
right.
you're going to have to pay.
Yeah, that's right.
Yeah. Yeah. Archana, I want to talk about your experience in advising clients on Division 7A and the things that have come across your desk. And I'm sure all kinds of different scenarios have presented themselves. But the scenario I want to get into is the situation where those loan agreements perhaps haven't been done on time. Perhaps a client or tax agents come to you 2 or 3 years after loans have been made, but nothing's been done. And what would you do typically in that type of situation?
Yeah. So in that situation, you said 2 or 3 years. The first thing I'd look at is whether the commissioner is, there's a time limitation for amending assessments. So if a deemed dividend arose, more than 4 years ago, then you're out of time. The ATO is out of time. You won't have to amend those returns. But if you're within that time period, then what I would do is I'd work out what the exposure is, and then I would consider, I'd tell the client to potentially make what's called a Section 109 RB application for basically exercise of the commissioner's discretion. I know this is all a mouthful, to either treat that loan as not as a deemed dividend, or to allow it to be franked at the very least.
Because when you look at that situation, you would be saying, look, well, you were supposed to put a loan agreement in by this date and you didn't. And the consequences of that are what you talked about earlier, being that there's an unfranked dividend. Now, they wouldn't have recorded that in their tax return, and they won't want that outcome.
Yeah.
So is that 109RB process about avoiding that situation?
So it's going up front, so not putting your head in the sand. And it's actually, if it arose because of an honest mistake or inadvertent admission, I think that's the language used in the provision, Andrew. Yeah. What I would say is you'd fess up to the ATO. You would offer to take corrective action. So basically, you'd make you'd sort of like work out what your payments should have been, and then pay that.
Put it back.
Put it back in the position that it should have been, and then you go cap in hand to the commissioner, saying, "Oh, we've messed up. We made a catch-up payment, so we've caught up with what would have been the situation if you had complied. Here's a Division 7A loan agreement we're prepared to enter into. Can you please?" And this arose because of all these inadvertent, mistakes, honest mistake. Yeah. And please, can you not treat it as a deemed dividend, or alternatively allow it to be franked?
And the ATO, you mentioned that it has to be an honest mistake or inadvertent omission. Is your experience that the ATO is starting to look a bit closer about those terms? Because I understand historically they were pretty loose with that, but they're a lot more, strict about those things now, and they're doing sort of webinars and education pieces to the community on this. Yeah,
so they're really scrutinizing that. They used to sort of push that through. But there is in the legislation there's a requirement, and now they're actually scrutinizing that. So that's very good point, Andrew.
And going to that scrutiny for a second. Now, the ATO has all sorts of audit and compliance programs, things like the Next 5,000 and the private group programs. Would you say Division 7A is one of probably the highest, or at least in the top couple of concerns that the ATO has for private businesses?
Yeah, it comes up all the time. Like you said, people treat, company money, private company money, shareholders, as though it's their own money. Yeah. So it does come up a lot. And it is a focus area.
And there's so many more complicated situations. I mean, we've gone through the basics about, okay, loan, put the loan agreement in place, that sort of thing. But, there are all sorts of different permutations that throw up really challenging issues sometimes that, need someone like yourself to advise on. One of those is unpaid present entitlements.
Unpaid present entitlements, Andrew, yes.
Yeah, UPEs, as tax nerds like to call them. It's not something we've talked about as part of this episode, but they are a bit of a sort of elephant in the room because they are so fundamental to this Division 7A conversation. In the next episode, we're going to talk about the recent full federal court case of the Commissioner of Taxation and Bendel, which is a dramatic development in this UPE and Division 7A conversation. So I'd recommend tuning into that, and I'm looking forward to breaking down that case, your thoughts on it, and what implications and what actions clients and advisors should take.
Well, I'm looking forward to it as well, Andrew.
Fantastic. Thank you.